After weeks of speculation, the back and forth over bad inflation theories, and a steady stream of seemingly hawkish FOMC policymakers, we know what the Fed's going to do next week. It's a done deal. The markets have spoken. Now, what comes after next week, somewhat of a different story, though maybe not as much of one as you might think, given all the noise that we've been dealing with up until more recently. Plus, what if I told you we have more solid proof that the economy is in far worse shape than it already appears, and the way it appears isn't that good to begin with? Now, the best place to go for confirmation about the Fed one way or another is right to Bill, as in Treasury bills. And over the last 3 trading days through yesterday, there is no doubt in the marketplace about the short run for the front end interest rates. Now, figuring out where everything goes from there gets a little bit trickier. We also can look at things like forward rates for clues for that. And when we do start to encounter the waffles. They're really waffles, not necessarily hawks. And the funny thing is, for all the fuss about Casey Jeff and his band and their tariff inflation story, forward rates have been largely steady throughout all of it. And we know why that is. I've covered the conditions in the jobs market this week, and there are a couple more updates to go over in terms of layoffs and really what's happening in jobless claims. But I think today would be even more helpful to cover the massive revisions that are plaguing major economic data, including one that came out just yesterday from the Federal Reserve itself. And what those revisions end up describing for consumers is simply astonishing. So that obviously has tremendous implications for rates and curves straight away, what they're pricing and what they're thinking, but also it's a warning that however you think the economy is today, whatever the numbers look like, they're almost surely significantly worse than they already appear. And the way they appear right now, not all that good. So we got the Fed that's likely to go back in the Pringles can no matter what they might have said up until recently. And then beyond that, the reasons why Pringles are so irresistible to begin with. And now we have more solid evidence that everything only goes in the one direction, whether it be revisions, economic direction, as well as interest rates. So will they or won't they? Well, let's put this to rest for good a week before it even happens. The Fed is going to lower its federal funds target range by 25 basis points on Wednesday. And how do we know? Well, after all we've heard since the last Fed meeting at the end of October, how there was no way there'd be a rate cut, not after Casey Jeff had dissented, and then seemed to pick up even more followers of FOMC members over the weeks since then, after the always worthless Fed funds future market swung wildly back and forth, going from pricing a December cut as a lock to then saying it was more likely to not happen, and now those things are flipping completely back to the other side again. Whatever those derivative instruments for pricing, whatever you heard in the mainstream media, the real money, the big money in the Treasury bill market is now all in, and I mean all in, on lower rates in the front end in the short run. The 4-week Treasury bill, for example, has seen its yield crash, and I mean crash by a whopping 27 basis points just in the last 4 days, including today. It was trading around an equivalent yield of 4.05% on the 28th, and as of today, unofficially 378, and that's with another 4.5 days left before we get to the Fed's announcement. The benchmark 3-month bill making a similar move, falling from 3.88% on the 28th to now 370. The yield for this one started moving lower before the very front 4-weeker, so you go back to the November 17th and it was up around 4% at 397. So another 27 basis point drop in basically 2+ week for the benchmark 3-month maturity. Again, these aren't derivatives. This isn't hedging. This is real money and real collateral. Big money too, huge amounts. Accepting lower returns, knowing that the Fed is going to be lowering its alternative rates, the RRP and IOR, not that anyone uses the RRP right now. So even a week ahead of the Fed, here we are with Bill having spoken. Forget Casey Jeff at least this month. Their tariff inflation nonsense has even less now than it did at the end of October. Zero hint of accelerating broad inflation, no evidence for it. Meanwhile, as we've been talking about repeatedly, the data continues to pile up, showing some firing to go along with still less than zero hiring. So flat beverage 1, Casey Jeff 0. Or if we include the October meeting, flat beverage 2, Casey Jeff 0. But as we'll see, he's not quite completely out of the picture just yet. So all of this makes sense in the context of what markets were saying, but nobody knows what markets are saying because of economics, central bankers, and the financial media. Well, here at Eurodollar University, we aim to fix that, and we're going to do that again with another stab with a webinar on Thursday, December 17th, 6 p.m. Eastern Time. We're going to talk about, I think we're going to really need to focus on why the Eurodollar is tightening and what it actually means moving forward. So again, I hope you can join me Thursday, December 17th, 6 p.m. Eastern Time. There's a link in the description to sign up for our webinar. It will be well worth your time. So before we tackle those waffles, let's go over the latest labor data that came out just today. First up, Challenger, Gray, and Christmas for November. If you remember where we left off with them last month, the number of October layoff announcements absolutely soared. It was the most for any October going all the way back to 2003, even more than October of 2008. Now, November wasn't that bad, but that doesn't mean it was good either. According to Challenger, there were 71,321 job cuts announced last month. Now, that's less than the half of the little more than 150,000 from October, but the real comparison that we need to make here is with last November. At 70+ thousand, this November's tally is still 24% higher and is the most for the month of November since 2022. Even more concerning, the only November since the Great Not Recession to come in above 70,000 were 2022 as well as 2008. So like October, November is way up there. And even more concerning than that, year-to-date layoff announcements have surpassed 1.1 million for only the sixth time since 1993. In those other years, 2020, pandemic and lockdowns, 2001, 2002, dot-com recession, 2009, enough said with that one. And now 2025 comes in fifth with only the jobless recovery of 2001. It's still more than 1.1 million job cut announcements. So yes, already 2025 is outpacing 2008 where it comes to layoff plans. And since the Fed is always reacting to weakness, there's more than enough of it just in Challenger's data to justify next week's December rate cut, and then probably a lot more beside. And then we turn to the really grim side, the hiring side that we've been talking about for the last couple of years of forgot how to hire, forgot how to grow. This season has been a complete bust for workers. Let's go to Challenger here. Quote, through November, U.S. employers have announced 497,151 planned hires, down 35% at this point in 2024. It's the lowest year-to-date total since 2010, when 392,000 and change new hires were planned through November. Going back to 2010, that's really not good. And included in Challenger's hiring figure are 372,520 seasonal hiring plans through November, which is the lowest number of announced seasonal hires since Challenger began tracking them in 2012. And the firm did not find any new seasonal hiring plans in November. And it's that last sentence that should send shivers down your macroeconomic spine. No additional seasonal hiring plans in November. None, not a single one. So for all the hoopla and hollering over Black Friday, the truth is, as I went over a couple days ago, all of that was just price increases. We keep getting more evidence showing that volumes have slid lower. Americans keep having to pay more to get less, which is why they're so angry, agitated, and pessimistic. If you're selling fewer items, you certainly don't need to hire more workers. And the fact that no one is hiring for the season is just more confirmation the economic climate is dismal from top to bottom, front to back, flat, flat, flat. But don't tell that to the Department of Labor, though. They just reported on initial jobless claims, which is a statistic the Federal Reserve watches, and many of the wafflers have been pointing out more recently. They just reported on jobless claims for the week of Thanksgiving that were at a 3-year low. So what's going on there? But rather than suggest renewed resilience in jobs or even contradicting Challenger or ADP more recently, you can never really trust the numbers around Thanksgiving to begin with. Moreover, the surge in layoff announcements that Challenger's talking about are just that. They're announced, not executed job cuts. Plus, they likely are going to have severances which will rule out those immediately who are let go from taking in state employment aid. So while several policymakers on the hawk side have pointed to steady jobless claims, they've been superseded by all the rest of the labor market numbers. Plus, you've got the Thanksgiving issue on top of everything. So while initial claims aren't going to let Casey Jeff have his day next Wednesday, other than probably another official dissent, That doesn't mean he and his fellow wafflers aren't still out there lurking in the background with their tariff inflation story. Both Schmidt and Cleveland's Beth Hammack have stated in public they feel that lowering interest rates even more will only add more invisible inflation pressure to the already indiscernible pressures they've been harping on for months now that continue to not show up in any of the evidence. This is what I call waffling. Rather than looking at the growing mountain of data, which does show real and sustained weakness in jobs, therefore jumping right into the Pringles can, what Casey Jeff and his group are doing is adding uncertainty to the future path of short-term interest rates. Just to be clear here, they are not arguing for rate hikes like you might think if they were really serious about these inflation pressures. What they're claiming is that policymakers still need more time to make sure that those inflation pressures that they worry about aren't actually going to break out. These hawks aren't actually hawkish. They're waffling on rate cutting. Their main argument is to hold rates so that they can make sure. It's just a feeling that they all share. And so it introduces that uncertainty into the path of short-term interest rates, creating the waffling over rate cutting. While that isn't impacting the bill market right now that the bill market's made up his mind about the short-run direction of travel for rates, but the waffling is somewhat apparent in forward rates, not in the way you might think, though. Term SOFR futures, for example, derivative contracts which pay off based on where short-term money rates are at various times in the future, they've stopped rising in price, but they haven't done much more than that. Let's look at the June 2026 contract maturity. From back in February, it rose in price, which meant the market was expecting lower SOFR rates by the middle of next year, even though at the time the Fed was on hold, and many policymakers tried to make it seem as though they were done. They were at their terminal rate last December. But from the start of May, see what happened to the contract price. It has basically flattened out around where it was up until the end of April. That's the waffling. That was Jay Powell talking about tariff inflation back when he's more worried about that than the non-solid labor market that he's worried about now. But even then, the contract price was still picking up through the summer and into the fall, at least until Casey Jeff showed up at the end of October, picking up from Powell. But it's not as if the market has completely rewritten the path of short-term rates to the first half of 2026. It is still expecting SOFR rates to be some level lower than they are now and will be next week after the Fed rate cuts. And by the way, the market doesn't price a specific number of Fed cuts in these curves, which you hear about in the media. Instead, you look at it as a probability spectrum. So if the June 2026 contract is priced around 96.60 as it is now, that isn't saying the market expects the Fed to cut once more after December and bring SOFR to 3.40% by the middle of next year. What it means is that there's a range of possibilities somewhat centered on 3.40. But even then, the probability range is skewed to the downside, which really means the market is thinking short-term rates by next summer could be as low as 3% or even less than 3%, or they might be up around 3.5% on the high side with a lower probability for that. But when you put the contracts together on the full curve, what it shows is that for all the tough tariff talk out of Casey Jeff and the constant waffling on rates as a result, it has not changed the probabilities of the rate cuts at all. It only shifts the possible timing and therefore widening the probability range in the short run. That's the uncertainty of the waffling. Going beyond June 2026, the SOFR curve still prices the Fed going below 3% and likely quite a lot below. All Casey Jeff is doing is changing the timing for when the FOMC reaches back into the Pringles can, not if it will. Now, I've said this before here on YouTube and other places, but probably not nearly enough. Whatever you think the economic data makes the economy look like today, it's almost guaranteed to be significantly worse. The numbers that we have are the absolute best case, and they haven't been good for years. Now, you already know what I'm talking about in the context of the establishment survey. The BLS spits out an initial estimate that gets revised down as more survey data comes in. A few months later, the happy number that was originally reported looks nowhere near as optimistic. And that's already bad enough. But what I'm actually talking about here goes a lot deeper. It takes this problem to the next level. And sticking with the context of the establishment survey at the start here, we've already covered the QCEW and the annual benchmark revisions to payrolls that come from it. That's the kind of thing that we're really talking about. For payrolls, the far larger, more comprehensive QCEW shows the establishment survey has been massively overstating the number of jobs for years. This comes down to how all of these statistics, not just payrolls, are put together. We don't need to go into all the mathy statistical stuff, but just realize there's a lot more subjectivity in them than you might actually expect. Basically, The statisticians have to decide what condition they believe the economy is in, and there's something called trend cycle. And if they believe the economy is in an expansionary period, that gets incorporated into the data as it comes out. And then much later, when statisticians have the larger samples and more data, they check to see if their assumptions about the trajectory of the economy were actually correct. And if the assumed trend was off, as it has been so much recently, the data then gets revised in these benchmark changes. So for the payroll data, that's just what happened. 2 years in a row, too. The BLS was thinking the economy and labor market was recovering far more than it really was. So the government originally estimated there were 2.9 million payrolls gained over the year after March 2023. But then they went back in the state and unemployment data, checked using QCW, which draws on those filings, and found out they were off by more than 500,000. There were only maybe 2.3 million jobs gained during those 12 months. And then moving forward a year to 2025, the BLS, after revising their estimates down for 2024 QCW, then they thought there were 1.8 million payrolls gained after March 2024 through March of 2025. And that's already a concerning low number. Anything less than 2.5 million for a year, for a yearly period, that's already alarming. So being below 2 million to start with, that already pointed to real trouble that we've been talking about with flat beverage this entire time. But then the BLS went back again with the QCW and found they likely overstated jobs and job increases by an even bigger amount, a record amount as it turned out. Rather than the 1.8 million between March of 2024 and March of 2025, it's more likely there were just 900,000 jobs gained in that 12-month period. That's incredibly bad. That's on the verge of recession. That's into the territory of job shedding. So again, as I said, however you might think the economy looks right now with the estimates that we have that come out, it is almost certainly significantly worse in reality, and it takes time, sometimes years, before the stats get revised and more accurately represent that reality. Now, we've already seen this happen with very large downward revisions to retail sales this year. Benchmark changes lowered total nominal sales by a couple of percentage points, and not just in a single month or two, but holding at that lower pace for years. That meant spending on goods was significantly less than it seemed when the initial estimates were first published. But now we have benchmarked revisions to industrial production. This is something that I've been covering for years, for over a decade now. Whenever the economy is in reflation, such as 2013 and 2014, 2017 and 2018, or 2021 and 2022, the assumptions that go into these statistics, the trend cycle that goes into them, ends up being way too generous. The input is way too optimistic, as if everyone expects QE and government policies to be more effective than they actually are. Where do they get that idea? So whenever a downturn comes up, these Eurodollar cycles that we always follow here at Eurodollar University, the situation in the economy, you already know it's much worse than it appears because the revisions haven't caught up to it. Just look at how industrial production behaved back in 2018 compared to where it really was after the benchmark changes were made years later. Overall production was a lot less than it had initially appeared, a lot less. That also means, by the way, the bond market was right, because remember back then, the yield curve and other types of curves had kept flattening out. And also remember, Jay Powell at the time thought the economy was going to be inflationary because they believed the face value of their own statistics, that production was better than it was, therefore demand for goods was hotter in their terms than it actually was in reality, because bonds were right. It was never robust on the upside, which meant that the downside that came right after it was even worse than everyone thought it would be. Thus, the rate cuts in 2019 when everybody thought they were going to be still hiking rates in 2019. But rather than learn from those mistakes, look at what the Fed has done the past 3 years of forgot how to grow. They forgot how to grow the bond market told us was taking place. Now the IP stats look like they did in 2018 after the revisions. The Fed just found out for sure the goods economy forgot a whole lot more growth the entire time, just like the curves were telling us. All the way back to 2022, all the way back. The economy was significantly less reflationary than it seemed in those numbers, and certainly in all of the commentary, the vibe session stuff that we heard along the way. And the worst offender here is the production of consumer goods. And that would seem to be a big one, don't you think? If producers were in reality producing a lot less for consumers, that would further establish what those producers in the real economy really thought about the state of consumers, and therefore, by extension, jobs, incomes, and everything that's important. These huge, and I mean huge, downward revisions to the output of consumer goods over the past 3 years mean, just look at the dismal state more recently. I mean, all of it together, there's your QCW revisions to payroll, the constant pessimism that's expressed in consumers in these sentiment surveys. It's an inside look at an increasingly flat beverage consumer economy and everything that goes along with it. So no wonder the December rate cut's a done deal. But that's a small issue, just like Casey Jeff's waffling. The SOFR curve's consistent position on more rate cuts from the Fed, more Pringles up ahead, it makes a ton of sense when you realize the economy you think you see today is in reality a ton worse. And since the economy that we think we see today is already pretty ugly, you can see what I mean when I say the economy is getting more, not less certain. And in every way possible, even revisions, it only ever goes in one direction. So quite naturally, interest rates are going to go in that same direction, and not just here in December. We're always looking for other kinds of confirmation, and we got that from Procter & Gamble, and it's inside look into the same consumer economy. That's all in the video link below. Check out Eurodollar University's webinar that's coming up. There's a link in the description to sign up. Huge thanks to Eurodollar University members and subscribers, and until next time, take care.